What is going on, guys? Welcome back to Econsphere. And today I want to talk about why your dollar buys less every single month. Now there are a lot of answers for this and we're gonna look at them one by one. But before we get started, please hit the like button and subscribe to our channel here. We would love to have you join the Econsphere community. And if you leave us a comment below, let us know what you think about the fact that your dollar seems to be buying less and less every single day. Alright, so imagine this. You go to the grocery store once a month to pick up the same set of items, right? Maybe it's cereal, milk, eggs, a loaf of bread. It doesn't matter what they are. The point is they're the same items. Well, something strange is happening. Your grocery bill keeps getting bigger despite the fact that you're not buying anything extra and you're not even getting brand name products. What is going on? Why does it seem that your dollar has gotten weaker? Well, in reality, the physical dollar hasn't changed. It's still worth exactly the same amount of money. But its purchasing power, how much stuff it can buy you, well, that is steadily decreasing. And this phenomenon is called inflation. Now, inflation is really complex and we've made a whole video about it already. But the basic idea is that inflation happens when there are too many dollars chasing too few goods. Or in other words, when the supply of money increases faster than the supply of goods and services, the value of each individual dollar declines, meaning that now you need more of them to purchase the same thing. And when you run your finger along a list of random prices, you can easily start to see how inflation erodes your purchasing power. A new car used to cost $30,000 in the early 90s. Today, the average price of a car is over $40,000. A movie ticket was $5 in the late 80s. Today, the average movie ticket is over $8. A Big Mac cost under $2 in the early 90s, but today it costs over $5. Of course, some things are way more expensive, like housing, tuition, or healthcare. Inflation in these categories can absolutely crush a budget, and it's no wonder that people turn to alternative investments to try and hedge against inflation. But you know what? Maybe I am oversimplifying things here, because there is not just one factor driving the decline of your purchasing power. There are actually 5 major causes of inflation that we need to discuss. So let's jump into those now. Number 1, stimulus spending. Now, we all know that the government spent trillions of dollars to help Americans cope with the pandemic, right? They sent out stimulus checks, extended unemployment benefits, and gave out grants to businesses. Well, all of that money flooded the economy and caused demand for goods and services to skyrocket. But the supply of those goods and services didn't increase at the same rate, and as a result, prices went up. An example of this is the used car market. The pandemic caused a huge shortage of new cars because factories were shut down and there weren't enough microchips to put in them. At the same time, everyone wanted to buy a car because they wanted to avoid public transportation. So the demand for used cars spiked, but the supply stayed low, causing prices to go up astronomically. Now, thankfully, the situation with used cars has improved, but it's not the only sector where this happened. In fact, almost everything got affected by supply and demand imbalances like this. Number 2, broken supply chains. Now, supply chains are the networks of people, companies, and resources that move products from factories to customers, right? Well, the pandemic broke these supply chains in 2 major ways. First, factories and shipping companies couldn't get enough workers, so production and delivery slowed down, which created shortages of goods. Second, there were shutdowns and port congestion, especially in places like China or Europe, which further delayed the arrival of imported goods. These factors combined to cause massive delays and backlogs, leading to fewer goods available in stores and higher prices. For example, the retail giant Target had to charter their own ships and pay hefty fees to bypass the backlog at ports, and that increased cost gets passed on to the customer. Number 3, years of low interest rates. Now, since the Great Recession, the Federal Reserve has kept interest rates near zero to encourage borrowing and spending, right? Well, that's great for the economy during tough times, But when interest rates stay low for too long, it can cause problems. When people and businesses can borrow money for nearly free, they tend to borrow and spend a lot more. And that extra demand can lead to inflation. Also, low interest rates can weaken the dollar compared to other currencies, making imports more expensive. And that can also contribute to inflation. Now, the Fed is trying to fix this by raising interest rates. But it's a delicate balance because they don't want to slow the economy too much and cause a recession. Number 4, greedflation. This is a new word that economists use to describe the tendency for companies to raise prices higher than necessary, especially during inflationary times. So while price increases due to inflation are often justified because businesses face higher costs, greedflation happens when companies use inflation as a cover to raise prices even further, taking advantage of the situation to boost their profits. For example, if a company's input costs rise by 5%, but they raise their prices by 10%, then that's pure greedflation. Now, we can say for sure how much of the price increases we've seen are due to greedflation versus legitimate increases in costs, but it's definitely a factor to consider. Number 5, global forces. Now, inflation is a global problem, not just an American one, and events outside of the United States can affect prices here at home. For example, the war in Ukraine disrupted the global supply of oil and food, leading to higher prices at the gas pump and in grocery stores. And in China, droughts and power shortages reduced the production of important goods like semiconductors and solar panels, leading to shortages and higher prices in the United States. Now, these global forces are beyond our control, but they're an important part of the story. Now, if you're feeling squeezed by inflation, you're not alone, right? Many Americans are struggling to keep up with the rising cost of living, and it can be hard to know what to do about it. But there are actually 5 steps that you can take to protect yourself and your finances. Number 1, don't leave your money in a savings account. Now, while it might be tempting to keep your emergency fund in a savings account because it's safe and easy to access, the reality is that with inflation running rampant, leaving your money in a savings account at 0.5% while inflation runs at 3 or 4%, you're essentially losing wealth. So consider investing your money in assets like stocks, bonds, or inflation-protected securities, which can potentially generate higher returns and keep pace with inflation. Now, it's important to note that investing does carry risks, and past performance is not indicative of future results. But diversification across different asset classes and a long-term perspective can help mitigate risks and potentially enhance your financial security. Number 2, pay down high interest debt. Now, while inflation erodes the value of your savings, it also makes debt more expensive. Credit card rates above 20% can absolutely eat away at your future income. So focus on paying down high interest debt to reduce your financial burden and free up more of your income to save and invest. Number 3, think long term and diversify. Now, instead of trying to time the market or make quick trades, focus on building a diversified portfolio of assets such as real estate, index funds, or commodities. By diversifying, you can spread your investments across different asset classes and potentially reduce your exposure to any single stock or market. And when you think long term, you won't be as affected by short-term market fluctuations. Number 4, stay informed. Understanding the economy and the factors that drive inflation can help you make better decisions about your finances. Now, of course, it can be difficult to keep up with all the news and analysis about the economy. And number 5, prepare for the unexpected. Unexpected events like the pandemic or a natural disaster can throw your financial plans off track. So it's important to have an emergency fund and to be prepared for unexpected expenses. Now, the Federal Reserve has signaled that they will continue to raise interest rates until inflation is under control. But there is a risk that they could trigger a recession in the process. If a recession occurs, it could lead to job losses and decreased incomes, making it harder for people to afford basic necessities. However, it's also possible that the Fed will be able to engineer a soft landing where inflation is brought down without a recession. Only time will tell what will happen. So what do you think? How has inflation affected you, and what do you plan to do about it? Let us know in the comments below. And if you want to learn more about personal finance, investing, or the economy, please hit the like button and subscribe to our channel here. We would love to have you join the Econsphere community, and I'll see you in the next video.